Hey, this is Nick the Car Guy with Military Auto Source in Daegu, South Korea, and you've heard the news. Interest rates are up. However, if you're in the market for a car, you really shouldn't be. In this video, I'm going to discuss why. Let's talk about the why. Let's talk about why rates have gone up. This is Mr. Powell. He is currently the chairman of the Federal Reserve. Long story short, banks borrow from the Federal Reserve. So when the Federal Reserve increases their rate to borrow money, our rates go up too. And that's why you're seeing this across all banks, and it doesn't really matter where you go. Why is he doing this? Well, if you look at economic playbooks that tell you when you're dealing with inflation, you increase interest rates to control the supply of money. That's why they're doing it. And hopefully what this means is this inflation, which we've all been experiencing in our daily lives, will get under control, and in the end, it'll be better for all of us. Now, that's the why. Let's look at the before and the after. Now, if I looked at every term, every length, all my banks, this would be too long of a video, so I decided to go with the top 3 banks for 60 months. I also decided that I'm not going to name any of these banks because a lot of these charts are probably, they don't want to be public. But in short, the average rate at the beginning of this year for prime credit on 60 months across all my banks was 2.8%. And then now it's about 3.43%, which is an increase of 0.63%. What does this mean to you in terms of dollar and cents? Here you can see payments for 60 months, assuming you borrow $30,000. I'm just using the average rate of all 3 banks. At the beginning of this year, it would cost you $536.40 a month, which will equate to $32,184 over those 5 years, which means you're going to pay $2,184 to borrow. Today, that same loan would be $544.81, which means you're going to pay $32,688 and some change. So you're going to pay $2,688 over 5 years. What does this break down to? In terms of 5 years, it means you're paying about $500 extra. If you were breaking down by the day, you're paying about 28 cents a day extra. I mean, it's not great news, but I also don't think it is this disaster that a lot of people think it is. And it's not nearly as bad as some of my customers are thinking it is. It's not good, but it's also not horrible. So, assuming you're in the market for a car, why shouldn't you wait? Here's the thing. If you look at the playbook that the Federal Reserve is following, chances are rate increases are going to continue. They're not going to stop. So if you're in the market for a car in the next 6 to 12 months, you might as well bite the bullet right now and get it over with. Yes, it will cost you more to borrow than it did 6 months ago, but it's probably going to cost you more in 6 months to borrow. So you might as well get it over with. Why is it not so bad? Military Auto Source does not charge above MSRP, which is a big benefit in this market, and you really can't forget that. Also, we don't push manufacturer financing, so you're still going to get good rates. And then, if the rates do drop, you can always refinance. So, you want to know more about Military Auto Source? You can call me. My number is there, 010-6598-2407. You can also email me, and my Facebook link is there as well. That's a picture of me with my wife. I'd be more than happy to help you. As long as you're overseas on orders and you do the deposit while you're overseas on orders, you can take advantage of our program. I look forward to helping you and answering any of your questions. I hope you guys have a wonderful day. Goodbye.